Good evening and welcome to Free Forex. Today is Sunday the 8th of December 2013 and with me Francesco Sani, and we're going to look at the Kiwi dollar and possible setups for trading this pair, Kiwi dollar and Japanese yen. So we're going to look at this pair and decide what we're going to do in terms of future movements. And one consideration with this pair, for me mainly, has been how clean the technicals seem to hold. And we have some parallels between what happened before 2008 and after. So, looking at making things very clear in my video, I'm going to use a new tool, which is from a video recording software, eVids, and this is a paint tool. So I'm going to highlight exactly which parts I'm talking about. So I'm talking about this level here, in parallel with this level here, and I'm also talking about this level here in parallel with this level here. Okay, so essentially we're looking at a line here and also a line here. Okay, so a sort of range of a few hundred pips. Now, just to make it really obvious, I'm going to undo these marks, and let's concentrate on what exactly I mean by a parallel between these different parts. I'm going to look at pre-2008, for example, and because this will give us the opportunity to look at similarities in patterns with what followed from 2009. First of all, I'd like to highlight this trend. Okay. So this trend is really consistent, and the consistency can be seen, and the consistency is also given by the following. We had 1 test, 2, 3, 4, and then finally it succumbed as the market crashed through it all the way down to this level at 44. Okay, so we have a significant trend that rose from this level here, 51. Okay, and the channel floor, or the floor resistance of this trend line here, taking us up all the way to this level here around 78. So just to recap, that's from about 51 to about 78. So we're talking about 2,700 pips. So this is huge. Okay, does this remind you of anything? Well, first of all, we have 2,700 pips, and we also have the number of period on the monthly chart would have been 79. So that makes it about 6.5 years. Okay. Now, again, with this in mind, we can go to the second half and really see any parallels that might have occurred after the 2008 slump, and see what we can find. So how do we approach this? Do we approach this in the sense that after 2008 everything is entirely new, or that it's not new, but we can't rely on exact repetition and nothing repeats identically ever? So we need to perhaps see how much we can sort of gather from it in terms of trading potential, of course, not just for the sake of it. And truly what we need to find is some sort of parallel between these two periods, here and here. So we want to create a line that gives us an idea of whether we're seeing a trend. And once we've got a line here, okay, we're going to basically extend the end and see where it goes. We'll make it red as indicative of the bottom of a channel or support, and then we'll do the same with the previous line actually here. We'll extend the end. Now we're going to see that there are these two parallel, almost near parallel lines, and this will give us an indication as to what we are able to do in this scenario. Okay, so we have these two parallel lines and we have this range in the middle, and it's a huge range. So to see the potential, we are here at the moment, and this range is, we're talking about a very substantial size, 3,600 pips, so it's enormous. And so far we've travelled only about, so up to here, 4,000. Okay, that can't be right. Yep, of course, that moves up. So far we've gone up to 2,450. So we've got another 1,000 and a bit. So from here, this stop here in April to the top there, we've got 1,000 and more pips to go. Now, there's another trick though, which is to try and figure out whether we have a repetition of this trend, or whether it's with sort of open tops or kind of flaring out. So in other words, we need to find out how much repetition we have. So here we have a high, this high, and this high. Okay, but these are not in a straight line. So in other words, we have an uptrend, but if we try to make a line here, okay, from this top here, so to this top here, we sort of have an up. Okay, but the only thing about that is you can see straight away that this line here and this line here are not parallel. So it's not a channel as such. It's more just an uptrend. Okay, so we can jolly well remove that. Now here, we want to see if that's the case as well, if it's flaring up. If it's flaring up, that means that potentially we're going to this range here, okay, is going to be, I'll just make it obvious. So we want to see if this range here is going to get higher here, and so on. So let's measure this and see if that's the case. Okay, we have, before we draw any lines, because we haven't really had much of a test, this is the first top, and then this is the second, so, and it's very recent, so we don't know. So I'm just going to measure these. So we have from here to here, we're looking at 2,260, and then we're looking at 2,480, so slightly marginally bigger. Yeah, marginally bigger, but not as much as, say, here, where we had 2,300, and this was 1,500. This increased much more. If we measured it from there, it would be 2,000. 200. Yeah. So this is more of an even top, and in fact, if we made it really a channel, it would seem to appear reasonable a guess that these a channel do make. Okay, maybe we'll do it here. Now if we drew the channel here, it would be more exactly parallel, so we extended the line at the end and made it obvious here, and that would be that. Okay, so if we made the top with this red candle top rather than the blue candle top, and so basically skip this month's top and went to the next one rather than this way, we'd probably have a better projection into the future as a parallel line to this. Okay, and so what the question is at the moment, I'm actually long, and I basically entered the position tonight at the reopening of the markets, and my point here is that I've entered a small position, and that's really to make it safe. So I've set my limit here, just above this green line, and a stop below the current candle. Now remember, this is a monthly chart, so obviously it would take potentially a little bit to get to this point, but I can wait, and the attraction to this pair in the long term is the yield potential and the rollover, so the interest paid on a day-to-day basis. So keeping your position open through obviously is a must if you're in the direction of the trend. You're accumulating points and the interest at the same time, which obviously doubles the attraction of this investment. So we have these positions. I'm just really going to finish with another thing, which is we're new in this position, so it's obviously a point to watch whether we continue to the upside and come to meet this that was the support line, now possibly resistance. So we have a two-tier system here. We have this potentially a channel, okay, that's going through the first test here, and maybe nothing else here, or potentially a second test coming a little bit more quickly. Also we have another thing, which is that if, but a big if, we had this period here that we said was 79, okay, 79 before the crash here, 79. If we had the same happening and we went for a second move to the downside, when would that be? Would that be between September and December? Well, actually September. 79 periods would take us here, okay? 79 would take us here. 2000, sorry, at 71.27 or so. And this would be September of next year, okay? So essentially that would be 9 months from now. So in 9 months' time, we could, and I say could, come to this point here, which is to come down to here, about here, okay? So we could end up at this point, and we could then potentially bounce back from here. So this is a scenario that I see happening with a channel of this kind, a longer term channel, but of course nothing is for sure, so we cannot be guaranteed that result. The alternative would be that after 79 periods or 80 months, we do what happened in 2008 and we break through here, and we basically just drown and dip into a huge lake of loss for the Kiwi dollar, and this sort of symbolizes a dip into the ocean, okay, because it will be a massive drop. So we're talking thousands and thousands. So it had to be something to replicate what happened here in 2008. This would have to be something quite substantial. Now, in 2008 we had the financial crisis. Also, this affected in turn the oil prices, which then again, being a commodity currency, rate currency, this also affected the New Zealand dollar, and so down it went. In fact, the New Zealand dollar is very much following the shape of the crude oil on a monthly chart, and with some slight divergence. At the moment, on a yearly basis, the two charts, according to the sort of tables of currency relatedness, the correlation is very weak on a yearly basis, but on an hourly basis, for example, the Kiwi dollar and the oil at the moment are very strongly correlated in a positive way, i.e. they move on the same direction, in the same direction. But the other thing I was going to finish with was that, without sort of showing this, so as to keep it quick, but the RSI showing that we are into overbought territory on the weekly and the monthly chart. We are in overbought territory. That doesn't mean necessarily that it's going to come down, but certainly something to watch. This level here, okay, so this level here is something to watch. But I would also add another thing as well, which is that we are 85.27, okay, so 85.27 is where we're at now. Now, if I did this and put a horizontal line here at 85.28 current level, 85.28, okay, bang on the level, and made it a different color, purple, and made it quite thick, not too thick. Okay. Now, this is where we're at now. So this is the current price, and I made a line from it. Okay, we see a number of things. One, that this price, okay, was resistance in these 2 months here at the beginning of 2007, so nearly 7 years ago. And it was also resistance here in at the end of 2005. So end of 2005, beginning of 2007, resistance, resistance, and one wonders, we are of course talking about a major financial crisis here, but for those who believe that technical analysis also reflects some other principle, which is a principle of patterns that we all share. Therefore, when a pattern is shared by many, there can be self-fulfilling prophecies, and one thing triggers another. And it is not impossible then to think that many people have been watching this, not for the New Zealand dollar necessarily, but for other markets, including oil and other currencies. They might have had a similar scenario or outlook. So this third test here, so broke to the upside and came back here, and then if we looked at these 1, 2 and 3, we could be seeing a squeezing sort of pattern, and then a break to the downside, and then a reprise of the upside, which means that we could be seeing 1, 2 and possibly a third coming up, which could in theory take us to a third further along here, or potentially even break to the upside, and then this would become a wedge, 1 and 2, and break to the downside. However, That said, what we would like to finish with is that so the point about that really was that the price level that we're at and the line that we have here is an interesting one, because really after so from this point here, 2005, December 2005 to December 2013, that's 8 years. So we have a essentially we have a cycle of 8 years from here to here. And we're starting to look at cycles here, okay? And if we have a cycle here, okay, to here of 8 years, okay? So we have a cycle from here to here, and then we go to this version of the chart which I drew earlier. So this is the RSI showing at a monthly level. We're approaching the overbought territory. We have approached it already. We came back down and approaching it again. So this could signal, as we test the top of this channel, a downturn and back down. Okay, so there could be further depreciation of the Kiwi dollar. The other thing I was looking at, there's a two-line. This is a slightly different version of what I drew before. So this is what I had before, okay, with this middle line here. If we actually changed that slightly and made this line here, the red line, okay, continue across, but in a slightly different way. Okay. Now you can see that instead of doing a trend line up there, what I did here was to extend this line from the beginning of end of 2001, from the beginning of this chart, all the way to here, to the bottom of this, which is September 2013. And what this shows us is that there's the bottom of this, okay, linked to the bottom of this, give us a line that supplies resistance here in 2009, 2010, but also gives us the bottom of this range, which is to about 1,000 pips from here to here, and this green line then continues, provides support here, and then becomes resistance here and resistance here. So we have a mirror version. Resistance, 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 support, support. Okay, so we have a mirror version here and here. Also support here, and on the other side of this line we have support here and support here. So this becomes a neutral sort of line. But so this basically, this space here, okay, this area here between these two lines is an area of 1,000 pips, okay, and this remains constant. So 1,000 pips here and 1,000 pips here. And in the middle we have this slash, which is the range from 2007 down here to January 2009. So essentially we have the crash, the market crash here. Okay, and this range is huge, over 5,000 pips. And if we divide it in half, the midpoint is then the 50 Fibonacci level at 71.04. So essentially 71. Okay, and this is the perfect middle, if you like, around which everything rotates. This perfect middle, if you like, is essentially take that off. This perfect middle is essentially here. Now, for the month of January 2013, the entire first month of 2013, January, moved between these two Fibonacci levels. Okay, and then it broke through, but then it didn't do anything except bounce off this continuation of this top here through here. So this 1000 pip range has now reduced here, and 1, 2, 3, 4, 5, 6. 1, 2, 3, 4, 5, 6. 1, 2, 3, 4, 5, 6, 7, 8 actually. 1, 2, 3, 4, 5, 6. Okay, so here it took 6 months from the first bounce at this level to here, and here we have 1, 2, 3, 4, 5, 6, well, about 7. So we are in a similar, we could say, scenario. And it really pays to look at these things and wonder, if we are now in a similar position to here, and we have an upside, will this continue to the upside as well? And if that were the case, okay, what of this area here? Because now we have completed this mirror. Okay, this mirror version being the following. I wish I'd make it really obvious. So we have this shape. 1, 2, 3. Okay, and this is a sort of sine wave kind of shape, with the middle here and the two arches here. So what happens at this point? Do we replicate the shape and continue again to the upside? So essentially a parallel line to this top level? In which case we should break through this, and in which case my long, the Kiwi, would actually continue unperturbed. Bearing in mind that the Kiwi rate decision is due this Wednesday, the 11th of December, and the forecast is that the Royal Bank of New Zealand will retain the current rate of 2.5%. So without any surprises there, if the Kiwi is going long against a weak yen, and the yen has not changed its rate decision, therefore there should be nothing against this continuing to the upside. Okay, in which case it could be a very huge number of pips, and that really seems to be the logical conclusion of that theory. However, the market is not going to listen to us, so if I got it wrong, please remember that this does not constitute financial advice. I'd like to finish as a disclaimer by saying that this is entirely my own forecast or probability of movement for price action with this pair. Therefore, please do not take this as something to go out and invest real money with. Also remember to set your stops and manage your risk carefully. I've also would just like to just show one more thing, which is the price overlay with the Kiwi dollar. And if we did it here, you'd be able to see if I made the other one into a line. So Kiwi dollar is that. Okay, so this is the Kiwi dollar, which I just sort of highlighted in a slightly darker color. Just make it a different color. I'm going to make it sort of pink color, so just to make it slightly thicker as well. So you'll be able to see. Okay, so the pink one is the Kiwi dollar, and you can see the thin line is the Kiwi-Yen. So there's a correlation between the two moving together. But watch what happens here. Okay, they're moving very closely together, and then there's a bit of a divergence here in the rate of decline at this point, and then here they start getting further. So the Kiwi-Yen has not sort of recovered as much, it seems, here, but then it jumped up here. Okay, so it jumped up here, and the Kiwi dollar sort of stalled a little bit here whilst this moved up considerably, and now they're back to moving together. So one to watch, the Kiwi dollar as well, to see if this push up in the Kiwi-Yen is mirrored by a push up in the Kiwi dollar. It could be a potential, obviously, for investing on both accounts, and obviously making the most of this positive correlation. However, obviously, if this turned against you, that would be a double whammy, so maybe not such a good idea. Maybe good to diversify. Okay, so with this in mind, we're going to finish here, and thank you very much for listening, and happy trading.